Hi, my name is John Olsheimer, and I'm a credit expert who contributes to creditcardinsider.com. Today's question is this: what does it mean when an APR is variable? So for those of you who are familiar with the terms of your credit card, you are probably familiar with your APR, or your annual percentage rate. And the APR is essentially the cost of carrying credit card debt from month to month, annualized, and it is expressed in a percentage. The average interest rate of a general use credit card like a Visa or a MasterCard or an Amex or a Discover is somewhere between 15 and 16% depending on the source that you're choosing to believe. It's a pretty high interest rate. The average interest rate, or APR, for retail store cards, so cards that have a brand of a store on the front and also where you can only use that card is at the store or the chain of stores, the APR of those credit cards tend to be much higher, well into the 20% range. When the Card Act was contemplated, or the Credit Card Accountability, Responsibility, and Disclosure Act of 2009, when that particular piece of federal legislation was being considered and introduced as a bill, meaning that it was not law yet, there was language in the bill that suggested that it was going to make it much more difficult for credit card issuers to adversely modify the interest rate on a credit card for credit card holders. So in other words, in English, it was going to make it harder for them to increase your interest rate. One of the loopholes that the bill created, and then the act, when it became law, ended up creating, was the issue of when can an APR be increased without any exposure to the credit card issuer. And one of the scenarios the credit card issuing community came up with was, instead of having fixed APRs, which means that your APR is what it is and it doesn't change unless there's some sort of negative event caused by the consumer, like if you miss a payment. But most credit card issuers decided to convert the APR from a fixed interest rate to what's referred to as a variable interest rate. And variable simply means that it can change over time because it varies. Most interest rates are tied to the prime rate. And right now, in September of 2014, the prime rate is actually very low, 3.25%. It's the lowest it's been ever, and it's been that low for several years in a row now. If that prime rate were to go up, then all variable rate credit cards, the interest rate on those cards would also go up, because your rate, again, is tied to the prime rate. And as the prime rate goes up, so does the interest rate on your credit card. So look at the language in the terms of your credit card holder agreement and determine whether or not you've got a fixed rate credit card or a variable rate credit card. Now, keep in mind, just because you have a variable rate credit card doesn't mean that that's necessarily a bad thing. All it means is that they're going to be able to increase the interest rate on your credit card as the prime rate goes up. And many experts believe that the prime rate is going to go up sometime in 2015. It has to go up eventually. It can't go any lower. The problem is that people tend to focus so much on their interest rate. They get tunnel vision and they think, oh my gosh, my interest rate's going up, I need a new credit card. But the problem is that most credit cards issued today are variable rate APR cards. And so the grass isn't necessarily going to be greener just because you've opened a new card. And finally, the only time that the APR is meaningful is if you choose to carry a balance from one month to the next. People who use their credit cards responsibly and sparingly, and therefore are able to pay them off every single month, don't have to worry about their annual percentage rate because there's no interest applied, because they haven't carried a balance and caused an interest accruing event. So if you're able to continue to pay your card off month to month, that doesn't matter if you've got a low interest rate or a high interest rate or a fixed interest rate or a variable interest rate. It's because it's all meaningless to you, because at that point, interest rates are really nothing more than a formality and aren't applied to your card because you never carry a balance. It's a good position to be in, by the way, because typically speaking, credit card interest is generally going to be higher than any interest you pay on any other type of loan. If you have any other questions pertaining to credit or financial topics, then please submit them to creditcardinsider.com. Thanks for watching. Have a great day.